Good morning, everyone, and welcome back to the MWB German Select Conference. It's now my pleasure to introduce Oliver Neu, CFO of DEUTZ AG. He will share deeper insights into the company's investment case and recent developments. Before we begin, just a quick housekeeping note. The conference is being recorded and all participants are in listen-only mode. After the presentation, we will move on to a Q&A session. Please submit your questions via the chat box. So let's get started, hopefully without a fire alarm. Mr. Neu, the floor is yours.
Yeah, thanks a lot, and also warm welcome from my side. It's an absolute pleasure to guide you today through some of the insights of DEUTZ Group. And let me start here on the first slide to introduce DEUTZ for those of you who might not be totally familiar with our group. So DEUTZ is in an interesting transformation. We are, on the one hand, the oldest engine company in the world. We were founded in 1864, so having a 161 year of history right now. But we are evolving into a system provider for innovative, sustainable mobility and energy solutions. So nowadays, we are way more than just an engine producer. Our product portfolio is for drivetrains for off-highway applications, so from diesel power to electric, but also growing especially on the energy side with the genset business. We have a global production network, a service network, more than 5,000 employees working globally for DEUTZ Group. 2024, we had 1.8 billion revenue. 2025, we are targeting 2.1 to 2.3 billion revenue, so seeing an additional growth over there. We structure our strategy along what we call Dual Plus. And our Dual Plus strategy consists of three elements. First of all, the DEUTZ classic engine business. That is where we see the diesel engines, the gas engines, so the DEUTZ heritage, the engine portfolio DEUTZ grew up with. And this is mainly or almost exclusively off-highway, so it's a different kind of market dynamic than in the on-highway, where the lifespan of the diesel engine is way longer on the off-highway side. We are targeting here being part of the market consolidation, playing an active role in the market consolidation, and we are very much focusing on performance, on margin uptake in order to increase performance of that basically cyclical business going forward. Second big block of our Dual Plus strategy is the solution segment. DEUTZ is providing or is developing towards a solution provider. That is especially in the field of energy, where we recently entered into the genset business, especially in the United States. So last year we acquired Blue Star Power System, which is a genset provider, 150, 160 million euros of yearly revenue, highly profitable, and a complete different market dynamic. The energy market is growing stably. It's a 7, 8, 9% annual growth rate, which we see throughout the market. It's way less cyclical and therefore increasing resilience of our business model. Second part inside the solution segment is new technology, which is what we formerly called the green activities, especially electric drive systems, also hydrogen engines, which we are covering here. Also, defense activities we recently are focusing way more on. We're covering that as part of our solution segment. The plus component in our Dual Plus strategy is the DEUTZ service business. And that is a highly profitable business. We are not disclosing the margins explicitly, but we are not just talking about 10% here. It's profitable, it's growing, and we are expanding the service globally. I will cover that in a bit. With that strategy, we set ourselves very ambitious targets. And we want to achieve nothing less than just doubling the size of our group by 2030. Last year, 2024, I mentioned 1.8 billion revenue. This year, the guidance is for 2.1 to 2.3 billion, and we are intending to grow the group to 4 billion euros of revenue by 2030. How do we want to do it? Well, you see here the three elements of our Dual Plus strategy. So the classic engine business, which will stay more or less at the revenue portion of 50%, a bit more than 50% by 2030. And we are not expecting big organic growth. We see a growth here, but that growth is basically the consequence of a market recovery. 2024, 2025 are like crisis businesses in the core industries like agriculture and construction. So we assume the typical cyclicity in a through the cycle development. But on the other hand, we see the effects from acquisitions. We bought last year or acquired some of the engine portfolio of Daimler Truck, but also we entered into a cooperation with TAFE, an Indian company, which will produce engines for DEUTZ, or in a cooperation from 2027 onwards. So the classic development is pretty much driven by that. The service side, we see more or less a stable revenue share of 25%, but that in absolute terms means growing the business from a bit more than 500 million we saw last year to around 1 billion euros in terms of revenue by 2030. On the service side, we want to grow. We want to provide service besides the DEUTZ engines for engines of different brands, but also above that, for example, being the service provider for entire service on mobile equipment, not just the engine. On the solution side, we see or we expect an organic growth, a growth rate of around 30% under 2030, especially growing the energy business. Energy this year, we will be like around 160 to 170 million euros of revenue. It's consisting out of Blue Star Power Systems and a smaller activity, a smaller company called Magideutz in Morocco. We want to grow that organically, continue that strong growth trend, but also inorganically via certain acquisitions we are targeting for. And on the new tech side, certainly the one with the least specific or least precise revenue growth path, but we are binding together things we are developing along the market. We want to be there once the market picks up. What we see right now is that market demand for new tech products is still rather low because the conversion, the trend to electrified systems is taking way longer in the off-road segment than it's in the on-road business. In order to give you a grip on the segments, we put it here rather explicitly. Since we are in a conversion towards a business unit, so moving from a functional organization to a business unit-led organization, we see here our engines and service reporting segment, which is consisting out of the engines business on the one hand and the service business on the other hand, bringing us to like 92% revenue, or 92% of the revenue still in this kind of business. While on the other hand, solution segment was 8%, mainly driven by the energy business, while the new technology revenue is still on a rather low level. In terms of fields of applications, I'm going to cover that slide only shortly. We see that our core industries are construction, material handling, agriculture, but also the genset business and the stationary systems. Especially on the construction and agriculture side, we see, especially also in Europe, that the market currently, the second year in a row, is in a sort of crisis. So we see on the one hand that service or that order intake is on a low level. The market is not yet recovering. However, that is a typical cyclicity which we have seen in the past. We are expecting an uptake of the market shortly. In terms of competitive environment, we see that DEUTZ is number 4 globally in the terms of non-captive off-highway engines providers. It's kind of hard to find the perfect competitor for DEUTZ since all the companies are in a way different. DEUTZ in a way is unique. However, those companies we put here are the typical companies you see as competitors. Product portfolio might be quite different than ours. Cummins, for example, is way bigger, of course, having a 78% on-road share as well. Zhejiang, the product portfolio is certainly on a different quality level than ours, but those are the names you typically see and hear when you ask for the competitors of DEUTZ on the engine part of our business. In terms of customers, well, you see here the creme de la creme, all the important names in construction, material, handling, agriculture, like Claas, like Echo, like Manitou, Kion, Terex, JLG, Broma, Liebherr, all the big names of the industry are all served by DEUTZ. Just covering the service business in a nutshell, because I think it's a very important part of our business. It's a part that definitely puts a lot of resilience into our business, and it's an area where we want to grow significantly. So last year, for the first time, we broke through the border of 500 million in terms of sales. We are selling more than 20 million spare parts per year. We have more than 1,000 service dealers globally, and thereby really having a network available to serve our customers all over the place. Roughly 67% of our business here is spare parts, highly profitable. We have exchange business, but also the billable service, the maintenance, where the technician goes to the customer to carry out repair works. Talking quickly about the recent developments, and I took here some slides from our H1 financial figures. So what happened throughout the business units recently in H1 2025? Well, in terms of engine business, we launched the TCD 3.9 engine, which is a state-of-the-art technical concept behind. We developed that in a cooperation with John Deere, and we see high demand from various international OEMs. The engine is going to replace our 3.6 engine, and that's a highly attractive engine going forward when it comes to the power the engine can generate. On the other hand, the Tafel Corporation, that's our corporation in India, which I mentioned earlier. So Tafel is from 2027 onwards on their own production lines, producing engines for their own demand, paying a license fee to DEUTZ. But on the other hand, also we are transferring parts of the Cologne production, 2.2, 2.9 engines, to Tafel to produce them cheaper, and of course getting access to a way cheaper Indian supply chain, which allows us also to benefit in our remaining production here in Cologne. That is well on track, that cooperation. We signed it last year. We're intending start of production in 2027, and we are very well on track in the entire execution of that project, also driving the revenue development going forward. On the service side, we continue our way of organic and also inorganic growth. Especially interesting here is a contract we signed with JLG in Spain, and we are about to sign things in the US as well. So we were appointed as authorized technical service partner for JLG in Spain. JLG is one of the world's leading manufacturers of aerial work platforms and telehandlers, and we offer a one-stop solution for all customer needs. That is part of our strategy to offer service not only on the engine, but alongside the entire mobile equipment, where we can make use of our strong global service portfolio. At JLG is here kind of a front runner. We are entering into appropriate contracts here. On the acquisition side, the inorganic growth, one more acquisition we almost completed. We signed it and expecting closing shortly. That is the acquisition of a Turkish DEUTZ distributor, Tatarkaya. Small company, but part of our strategy, which we successfully executed over the last years as well. You might remember we acquired in Chile, Maurizio Hochschild. We acquired DEUTZ Nordics, formerly named Diesel Motor Nordics, in the Nordics, in Sweden and Finland. We acquired recently an entity in Poland, so we are step by step increasing also inorganically our service business globally. On the new technology side, interesting development here, we acquired Urban Mobility Systems. It's a Dutch specialist for the electrification of off-highway vehicles. Closing of that acquisition was beginning of June 2025. We are now in the integration, and that gives some positive business trajectory with some ongoing deliveries. So they are providing electrification kits mainly for state-of-the-art customers like Liebherr or Hyundai, and basically changing the diesel engine, taking it out, putting an electrified system in. And it's mainly a technological step forward for a few years, which we managed by this acquisition. So it's perfectly matching with the existing DEUTZ product portfolio, and allows us to move ahead here and keep a technological leadership. Combining their technology with our customer access is certainly a value driver going forward. On the energy side, I mentioned Blue Star Power Systems. We acquired Blue Star in August 2024. So it's now the first full year in our results. We see they are running strongly. They are fully booked until the end of the year, and even further. They run operationally at a margin level of above 20% before so-called purchase price allocation. So certainly something paying into diversification of the product portfolio, but also to resilience in our business model. The business unit defense. We are bundling our activities globally. DEUTZ is, for the time being, not yet a defense company, so we're just a low double-digit revenue last year in defense. This year targeting towards a mid double-digit million euro revenue. However, defense is an attractive field for DEUTZ. Our products are suitable to serve that market as well with slight adjustments, and it's certainly something we are looking into it. We are bundling our activities, be it in the field of engines, be it in the field of service, or also genset on the genset side. We have some projects ongoing, V8 power pack together with Rank, and also other projects. So we are expecting some good developments in that business unit. In terms of figures, on the H1 side, we see new orders have been at a bit more than 1 billion. That's a 30.7% uptick on a year-over-year basis. Honestly, that was driven also by the M&A activities. So roughly 250 million out of the new orders were driven by the M&A activities, especially Blue Star Power Systems, but also the Daimler Truck engine portfolio, which we both acquired in August 2024. So they haven't been in the figures in the first half of the year 2024, but they are, of course, fully in the figures now. And these M&A effects, those two and some smaller others, are driving the positive development. On the revenue side, it's also approximately 250 million driven by M&A effects. So adjusted for that, there was a 13% decline, reflecting the currently low market conditions. That is not a structural issue, that is a pure market issue, especially on the agriculture and on the construction side. We are seeing that sentiment indicators since a while are turning in a positive direction. However, we do not see that yet in the orders, but we are fully prepared once the market is picking up. In terms of profitability, 4.7%, first quarter at 4.3%, second quarter at 5%. So we see a positive development there. And for those of you who know DEUTZ from the past, well, a margin level of 4.7% in a year where the original core market, the engine market, is in a economic crisis, that is certainly a good margin. Are we happy with that? Not at all. We are striving for 10% by 2030, but we are on a good track here. And once the market is picking up, which we are expecting somewhere towards end of the year, and then certainly next year, then we are totally prepared with the adjusted cost structure, cost base as well. Free cash flow, we are targeting for a mid double-digit million euro amount this year, and we are fully on track. Free cash flow before M&A. Talking very briefly about the different segments, the reporting segments. You see here the segment engines and services, which I mentioned earlier. You see the margin level H1 at 6.1%. So the unit sales were down by 10%, production by 15%. That was a market-driven part. On the other hand, the portfolio measures, which I mentioned, were compensating big part of the effects, and also the strong work on the cost reduction was compensating part of it. Service business remains strong, 8% year-over-year growth, both inorganically and organically. Solution segment is consisting of the two different, typically totally different businesses, like the stable and growing energy business. We have been at 18 million revenue. That's fully on track with the full year targets we are putting there. Adjusted EBIT at 8 million, and you see there in the footnote, it's the EBIT before purchase price allocations are really technical accounting effects as a consequence of the acquisition, has been way higher at almost 14 million. So there's a high profitability in that energy business. And the new tech side still, as mentioned, with the low revenue and losses mainly driven by R&D expenses. Balance sheet and financing, just covering that quickly. Equity ratio remains strong, leverage remains decent, dividend remains stable. So we are well financed and absolutely well positioned to support the further growth, be it organically or inorganically, to achieve our 2030 targets. FutureFit, just a few words on that. That's the name of the cost reduction program. We are targeting to reduce cost by 50 million 2026 compared to baseline year 2024. More than 25 of that we're expecting this year. You see here how the measures are split in different areas. We are absolutely well on track, especially most important measures, reduction of 300 FTE, which is confirmed, 225 FTE reduction in Germany, 75 in the rest of the world, a big portion of that already out or being out until the end of the year, the remaining part then next year. That brings me to the guidance, revenue guidance, 2.1 to 2.3 billion, 5 to 6% adjusted EBIT. So H2 is expected to be stronger than H1. And the cash flow target, as I mentioned, guidance is confirmed and we are well on track there. Last but not least, to also allow some time for questions, though it's few investment highlights from my personal perspective here, we have a clear growth path going forward. We want to double DEUTZ, getting to 4 billion in terms of revenue at an adjusted margin of 10%, and we are well on track. We are executing our strategy, the strategy for profitable growth in the existing areas, but also in the new areas. We are adding resilience to our business model, and we see the first effects in the actual figures. It's not just on the PowerPoint slides. Future Fit cost reduction program will further increase that resilience. It will further lead to an uptick in the margins. 50 million target also well on track. Balance sheet remains strong. Equity ratio remains strong with more than 45% equity ratio and a low leverage. So we are financially strong enough to support the growth, also the inorganic growth. And last but not least, from an investor perspective, also important, dividend policy. We are committed as a management to stable or higher dividend per share compared to the always compared to the year before. That's DEUTZ in a nutshell. Thanks for the attention, and I'd like to open the Q&A now.
Thank you very much, Mr. Neu, and we already have quite a number of questions, so I'll dive right into it. First one is on your product portfolio. So on the competitor level, there have not been any names like Mercedes or other European names. Is that just related to the size of your motors you are working on?
Yeah, we put there on the competitive side, we put the non-captive players. Yeah, so we are in the off-road market and on the non-captive side, and that is why we put that selection there on the engine side.
Okay. Another question is, how do tariffs impact your business, and do you have any production sites in the US?
Second part of the question, we have a production site in the US where we are basically doing kind of value add production. So we take the base engine from Germany, produced in Cologne, prospectively, partially then also in India. We deliver it to the US and they have some sort of value add production. They also have some exchange business, so taking old engines, revamping them a bit and selling new engines. So not the full value chain over there, just a small value chain. The value chain could be extended, which we are currently not planning. Tariff impact on the current tariff levels, it's minor or neglectable. So we see, we are confident, and we see that in the discussions with the customers that we are able to pass over the 15% tariff to the customers. We are in very good discussions with the customers, have the first agreements with the customers. So if it stays at that level, we are very confident that it will not impact the margin level. However, it remains to be seen how US customers and the situation, which is always very dynamic, as we know, develops going forward. And last but not least, to the tariff question, I mean, we are impacted mainly also on the engine side. We have, of course, also our Blue Star business. So out of the $500 million revenue, which we have overall in the US, 150 million is coming from Blue Star. They are importing a bit of engines, but also have a bigger part of value add there. And also on the service side, the technicians, they are, of course, not affected by the tariffs.
Great, thank you. Next question is, the company's midterm revenue ambition projects a significant shift with solutions and service becoming a much larger part of the business. Could you provide more detail on the anticipated margin profile for these segments as they scale?
Yeah, we are not providing any specific details on the individual margins. I mean, service stays at a proportion of rather 25%. It's growing in absolute terms, with the relative proportion It's expected to stay the same. Service is highly attractive. We are not just talking about 10% margin here, so that's a significant double-digit margin as it's typically for the service business. The energy business inside solutions is on a highly attractive level. It's consisting mainly out of Blue Star Power Systems plus a bit of DEUTZ, and you saw the profitability figures in the segment reporting with the 20% operational margin of Blue Star, 14 million profit for the entire energy segment before purchase price allocations effect, over 80 million profit in H1, and that is running stable. Yeah, so we do not see the big ups and downs there. So it's a stable margin level. And on the new tech side, we are not yet in a break even. That might take a year or two to get to the break even side. But of course, in all those areas, new tech and service and energy, we are also going for inorganic growth. And of course, we're always targeting value accretive transactions.
Great. The next question is on the organic growth or decline in order intake in the first half of 2025. Mm-hmm. You presented the full numbers, but the question is, what was the organic development?
The inorganic part in the order intake was 250 million. If you deduct the 250 million from the 1.03 billion, then you can compare it then year over year. I don't have the precise comparison figure now, but the inorganic part in the order intake on a year-over-year basis was 250 million.
Okay, great. Did the recent power outage in Spain stimulate the expected demand for DEUTZ emergency power solutions?
No, we didn't have any impact there. We have the two production sites, Blue Star, that they are delivering in the United States, 85%, and Canada, 15%. They are fully booked with that. And we have DEUTZ targeting more the African market. We are looking into opportunities in the Europe and EMEA region besides DEUTZ, but there was no specific impact from Spain. However, it showed once again that there is a need for stable energy, a need for decentralized solutions, and that is certainly something which is overall showing why the organic growth of the energy business is so strong, where we want to participate from.
Next question is also on Blue Star. In the US market, supermarkets represent a growing customer segment for Blue Star over the next quarter, as a question?
Yes, we have one big customer called Ravenwall delivering also the gensets to Walmart, for example, and that is a segment where we have strong demand, where we see strong demand, especially in the cooling chain. It's in different areas. The demand is growing there. Data center is another area where we are not yet so strongly inside with Blue Star. It's a general area where demand for gensets is growing. So there are throughout different applications or different segments, demand for energy is growing in supermarkets, given the necessity for well-functioning cooling chains is one of those things.
Great. We have 4 more questions in 1 minute, so short answers, please.
Okay.
Have you considered investments in self-driving technologies?
No, we have not. We are on the engine side and the drive system side. Okay.
Current trading conditions, how has Q3 started versus your FY25 ambitions?
We are fully on track with our guidance, and we are commenting on Q3 then as part of the quarterly figures.
Okay, 4 billion revenue target for 2030. What roughly is the business mix for this assumption?
Business mix was shown on that slide before, 54% for the classic engine business, 25% service, remaining part in new technology. Out of the new technology, in solutions, out of the solutions part, 500 million roughly in the energy business, the remaining part a bit lower than 500 million then on the new tech side.
Great. And last question, hydrogen is still at the early stages. When it comes, when will there be volume business?
It's a good question. We are cautious there. We do not see the demand yet picking up. We have the 7.8 liter hydrogen engine ready to go. Technology is there. It's pretty much a question of the infrastructure where the government comes into place to create an infrastructure. We are supportive of that. We like the product, but we do not see the demand yet.
Great. We just made it in time. So thank you very much, Mr. Neu, for these insights and the good answers to the questions and for hurrying up, especially at the end. Our participants have received a questionnaire, so we would very much appreciate your feedback on the event. And the next event will be Eckert & Ziegler, and there is a link leading to that event in the chat box. Just click on it if you want to attend. So thanks again, Mr. Neu, and I will hand it over to you for any final remarks.
Thank you very much for your attention. I will keep it short. It was a pleasure introducing DEUTZ